This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks set to extend Wall Street gains as Beijing's trade delegation says consensus has been reached on the Geneva agreement. Treasury Secretary Scott Bessent returns from the tariff talks as Bloomberg reveals a growing push for him to succeed Jay Powell as Fed chair. And here at the Morgan Stanley Summit, we speak exclusively with guests including Australia CEO Richard Wagner about trade wars, deal-making, and the bank's own business plans. And we do have breaking news at the moment. We are hearing from China's trade negotiator that they've reached consensus with the United States when it comes to the Geneva agreement, the deal that came out in May of this year. Of course, there was a lot of back and forth that both sides were not adhering to that deal. But now the trade negotiator Li Chenggang saying that he hopes for progress to be conducive to building trust, saying that the teams will report back to their respective leaders. We're also, of course, trying to get more clarity on what happened in those London talks. It was a second day of talks for the U.S. and China side. We know that Secretary Bessent has already left the trade talks with China to testify before Congress, and who were left were Secretary Lutnick and also USTR Jameson Greer continuing those discussions. And this latest update now, China saying that they've reached consensus with the U.S. on the Geneva agreement. What that actually means, we still have to wait to see, because both sides were trying to get more progress on allowing China for more rare earth shipments to the U.S., not to mention that the U.S. was trying to remove measures targeting certain exports as well. So we'll continue to watch the latest developments in London as we also take you through the trading session today. Take a look at how we're setting up in the Asian session, because, of course, we had some gains when it comes to the Nikkei for the past three sessions. We saw the Japanese yen weakening against the U.S. dollar, with the Bank of Japan Governor Ueda now saying that there's limited room for policymakers to stimulate the economy should it confront severe downturn pressures. We're also getting the latest from South Korea when it comes to the May adjusted jobless rate coming in at 2.7% as expected. 245,000 South Koreans were added employed in the month of May. South Korea is also saying that they're seeking to set up a bad bank with an extra budget, according to local media, as we have continued to watch that market, because Korean assets have been rallying given the new president taking the helm after 6 months of turmoil. Take a look at what we're seeing in the U.S. session, because futures right now looking like this after small gains in the overnight session. We're about less than 2% away from the February record that we saw with the ongoing China-U.S. talks, leading to a little bit more optimism in that market. But we're seeing a little bit of downside pressure, not doing much very early in the Asian session, as, of course, we're also headed to the key CPI data. Treasury supply also coming with $22 billion of 30-year government bonds need to be sold on Thursday, not to mention that there's a 10-year auction as well. But let's turn back to the trade talks, because that's really what's moving markets at the moment. We continue to watch the optimism over the trade negotiations, perhaps also the skepticism as well. The U.S. and China have wrapped up in London, and now Chinese official Li Chenggang saying that both sides have agreed to a consensus based on the Xi-Trump call that they had last week, not to mention the Geneva meeting in May. Let's get to our chief North Asia correspondent, Stephen Engel, in Hong Kong. And Steve, of course, we're still trying to figure out what consensus actually means. But leading up to what the Chinese officials said, what were the expectations of where they could find some common ground?
Well, I think they were trying to reestablish the commitments that were made in Geneva about a month ago that quickly unraveled with more tech curbs coming from the United States. And what the White House said was China's slow approval process for licenses for export of those critical rare earths, including the very key rare earths that are used for magnets that are used in aerospace and defense industries in the United States. So we don't have those specific details other than the Vice Commerce Minister, as you rightfully said, essentially saying that the two sides, after 2 days of talks, have reached consensus. They will now depart essentially to go back and report the progress back to their respective leaders. Does this mean those talks are finished this time? I don't have the actual confirmation of that because Howard Lutnick, the U.S. Commerce Secretary, earlier said we would go into day 3 if needed. It's midnight or just after midnight in London, so perhaps that has concluded 2 days of that second round of trade talks. We already know that Scott Bessent, the lead negotiator for the U.S., the Treasury Secretary, had departed earlier from London back to Washington to testify before Congress, leaving Greer, Jameson Greer, the U.S. Trade Representative, and Howard Lutnick to lead those talks with their counterpart across the table, the Vice Commerce Minister Li, but also, of course, the lead negotiator, He Li-feng, Vice Premier. So there you're seeing Howard Lutnick. I'm not sure if this is live shots right now of Lutnick talking about that. It is live. Are we listening in to Howard? No, we're not listening into them. This is live TV, folks. Essentially, though, of course, we're going to get the details coming on whether indeed China has made a significant pledge to speed up the export licensing process for those key rare earths, and whether the United States, as we've heard from sources, are willing to backtrack, pull back on some of those export controls that they added following the breakdown of that truce reached in Geneva on jet parts, on chemicals, on nuclear materials, and the like. So we'll have to see the details when we get the U.S. Reading out their assessment of 2 days of talks in London. I guess I can keep on talking. Shery, are you there?
Yeah, I mean, Steve, we were waiting for Haidi Stroud-Watts, who's right now at a live conference in Australia, to jump in, but it seems we don't have that connection as of yet. As you said, live TV, but what can we expect next? I mean, you were trying to figure out if we have more conversations going on. It's already been 2 days. I mean, how much can really be achieved in 2 days when we've talked about the complexities of this negotiation?
Yeah, that's right. So the time is of the essence right now because the U.S.-China truce that was reached in Geneva last month extended this reprieve on tariffs down to, of course, 30% on China from the United States, which is a 10% base plus 20% for the fentanyl issue. And then China reduced its tariffs, reciprocal tariffs on the United States down to 10%. That truce on tariffs essentially lasts till mid-August. But other trading partners of the United States, that truce, if you will, or that pullback pause of the reciprocal tariffs down to 10% baseline expires July 9th. So you have key trading partners like Japan, South Korea, India in active negotiations with the White House right now to try and reach some sort of trade deal before that July 9th deadline. Keep in mind, only one trading partner with the United States so far, the United Kingdom, has reached a trade deal following the announcement on Liberation Day, of course, of these tariffs. And then, of course, the pullback, a 90-day pullback. So, again, there is a time element right now for a number of trading partners with the United States. It looks as though, and as I recap the headlines coming from the Vice Commerce Minister Li from those talks in London, that the two sides have reached consensus and that they're going to report back to their respective leaders to see where we go from here.
Our Chief North Asia correspondent Stephen Angle there, and we are hearing from the Commerce Secretary Howard Lutnick there speaking to reporters with that update saying that China and the US have reached a framework for implementation. Let's listen in.
It's been President Trump's fundamental goal is to reduce the trade deficit and increase trade. So this was the first step, the framework by which we will then approach and discuss growing trade. But first we had to get sort of the negativity out, and now we can go forward to try to do positive trade, growing trade, and beneficial to both China and to the United States of America.
Do you feel confident to make agreements before the 12th of August?
Can you repeat that again?
Do you feel confident to make any agreement with China before the 12th of August?
Before the deadline?
Well, we know that they're motivated. Our president is motivated. We're moving as quickly as we can, so we would very much like to find an agreement that makes sense for both countries. The relationship is complex. There are challenges that can't be eliminated in a couple of months, of course, but there are things we potentially could do. So, I just think we feel positive about engaging with the Chinese, understanding the real challenges we've had for many years, and some will endure.
So if there's no movement, then extend the deadline. Extend to the deadline.
Well, listen, that's going to be up to the president, right? I mean, all of this is up to the president. He's been asked directly about this sometimes, and he says something like, "We'll see." So I'm not going to say more than that.
The restrictions on chips like the H20 from NVIDIA, will they ever be on the table to lift those restrictions?
I mean, again, this conversation is about the Geneva consensus, the Geneva agreement, and implementing that. I mean, when it comes to export controls and all these different things, I mean, in 8 years of negotiating with the Chinese, I've never had a meeting where they didn't want to talk about export controls and that kind of thing. I mean, we're focused on the Geneva agreement. We're focused on the calls from the president's implementing that.
Will we see more rare earth minerals coming?
That is
We
definitely our
do
expectation.
absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way. When they approve the licenses, then you should expect that our export implementation will come down as well.
What makes this meeting different than Geneva?
Is that a time
What
frame?
was
Is there a
asked
time frame
outside
for that,
Geneva?
then? Is there a time frame?
Well, the difference between this meeting and Geneva is Geneva set the framework, but for whatever reason, it just wasn't happening. It was going too slowly, too painfully, and so we put that on the table. But most importantly, you had President Trump and President Xi on the phone together, and they gave sort of the fundamental foundation on which we were able to reach agreement. Without those two leaders, it was very difficult, but with the two leaders talking, I think we both sides had that strong push to let's get this done. That's why we stayed at it so late in the day, that we never stopped. We started early, we ended late. You have to get things done if you're working for President Trump, and I'm sure they felt they had to get it done because they were working for President Xi.
Are they going to have another phone call anytime soon?
Oh, you'd have to ask them. That's between them.
Did they seem motivated? Did the Chinese seem motivated to come to some sort of agreement?
Oh, we're here. What time are we talking to you? I mean, obviously it's 11 and a half hours, 12 hours since we got together, right, this morning. More, right?
Well,
More.
When was the call with the president? It's like Thursday morning, and it's
Right.
It's like,
Thursday.
yeah,
Monday.
Thursday,
I mean-
right? And we did on
I mean, we
Monday,
got
so-
together at 10 this morning. It's
Obviously,
almost
you're-
midnight, so it's
But
14
there will be
hours
no new
of being
agreement
together.
issued in writing after
Well-
the talks in London.
Well, we have an agreement. We have the Geneva agreement. Right now, we've agreed on a framework to implement that, right? We have an agreement already.
What does that framework look like?
When do we get to see the framework?
Well, I mean, this is, we have the Geneva agreement. That's what we're keying off of. And we're working together very closely with them to make sure that the implementation goes forward speedily.
Geneva was 4 weeks ago. How do you avoid having this situation happen again?
Well, I think the difference this time is you had the two presidents on the phone together, really creating the foundation that is the purpose that this framework is built upon. So it was the combination of Geneva's consensus coupled with the president's phone call led us to feeling actually very confident that we will work this out. Now, President Trump's got to approve it. The Chinese side has to take that back to their president. And then once that's done, we will be back on the phone together and we will then start to implement this agreement.
But do we have any breakthroughs? Any?
Well, I think we have the two largest economies in the world have reached a handshake, right, for a framework. We're going to start to implement that framework upon the approval of President Trump, and the Chinese will get the President Xi's approval, and that's the process. So once the presidents approve it, we will then seek to implement it, and it is by definition, two giant economies have lots of complex issues, but I think we pounded through all of them, and I think we've reached a framework to implement the agreements that have been reached.
Did you guys have a call with President Trump today? or yesterday to brief him on the talks?
Obviously.
And what
What
was
is
his
his
reaction?
What's his reaction?
Well, the motivation for the team is clear. The direction was clear. The conversations were clear. And I think the outcome, now we're going to go fly back and we're going to go brief, the three of us are going to brief President Trump and we'll get his take on it. And then we will start the implementation phase with our Chinese counterparts.
How many sections are this framework? I mean, what are we looking at? A big document? Is it multifaceted? Are we just talking about export controls versus minerals?
Well, the benefit was Ambassador Greer and Secretary Besson had really already done this work in Geneva a month ago. So this is really sort of making sure there's meat on the bones, the agreement is complete, the presidents are behind it. So they really already did the framework work. And this was really just getting everything ready for its implementation. And so I think, this is very consistent to where we've been, to where we're going. I think it's really beneficial to the United States of America. It's really beneficial to the Chinese and the China economy. And I think we will grow from here. We will implement, and then we will seek to grow our trading between the two countries. America has, again, a large trade deficit with China that we are going to focus on. And the idea is to do it in a positive way and to grow our trade with China, which will reduce our trade deficit. But first, we wanted to get the framework launched.
Is there enforcement in this deal?
As long as Donald Trump's the president, there's going to be enforcement. Just trust me on that.
Well, that's a really good answer. I love that
Did the
answer.
trade deal come up, purchasing agreements?
What's that? So again, listen, we're ready to have a larger conversation with the Chinese on the types of topics you've talked about, and they've telegraphed now and then the kinds of things they might be interested in. We are very focused on implementing the Geneva Agreement and the president's consensus. That's number one. When that happens, that's really going to unlock the ability to talk about more things. And again, there are some things that the Chinese and U.S. economies, they just don't fit together very well. Other things maybe they do. And there'll be a time for broader conversations on that. And we certainly, touched on that throughout these meetings, but these meetings are really accelerate implementation of Geneva contingent on the president's mutual agreement.
The fentanyl tariffs, though, are still in place. Is there any progress you're seeing from Beijing on fentanyl?
Well, that was a topic of discussion for specialists here, right? Each side had a specialist to talk about fentanyl. Clearly, that's a priority for our president, and frankly, for all Americans, right? This is not a partisan issue. We would expect to see progress from the Chinese on that issue in a major way.
Are you coming back to London in the future?
We don't know.
No, but it was wonderful. Our hosts from the United Kingdom, they really provided a wonderful place for us to meet. It was easy. It was comfortable. Both sides felt very comfortable, and I think it created a great atmosphere in which to get a deal done.
Did the court case against tariffs, President Trump's tariffs, come up? Did that affect your leverage at all?
It did not.
That doesn't come up.
It did not come up at all.
Do national security issues complicate this? There were Chinese nationals that were arrested with agro-terrorism weapons or bio-weapons in the U.S. Did that cause a problem?
I mean, that didn't come up at all. I mean, all of these things listen, we're talking about geopolitics and grand strategy. Some of these things are dealt with in compartments, right? And obviously we go back, and when we say we're going to brief the president, we're also going to brief all these other people, right? National security folks, et cetera. Right? Everyone wants to know about this, and everyone's balancing everything. We didn't talk about those things here, thankfully, but obviously there are people in our government who think very serious about those things.
What's the status of the other countries you're negotiating with?
July 9th? We're just here to talk about China. So.
Thanks. All right, thank you all. Thanks for staying up so late waiting for us. I really appreciate it. Okay, we'll see you soon.
Thank you very much.
You were just listening to Commerce Secretary Lutnick as well as USTR Greer. They're in London after wrapping up conversations with China, both of them agreeing that the framework has been reached with Beijing and that now they need to implement it, saying that they got on the phone with President Trump. They briefed him about the talks, that once both presidents from both sides agree, they can actually go moving this along. But let's bring in Bloomberg's global economy correspondent Enda Curran joining us now from Washington. And Enda, what I could get from both of them talking, and also also from the Chinese side, because we heard from Li Chenggang earlier, is that both sides seem to be pretty motivated to get to a deal to ease tensions right now. How much do these two economies need it at this point?
It clearly sounds like the US delegation, at the very least, is talking up whatever has been agreed. Shery, to your point, the language is around a consensus. The language is around a framework. And clearly it seems as though it sounds like a kind of a reboot of the Geneva Agreement about a month ago. Both sides have said whatever confusion there was between then and now, they're going to go back and get that off the ground again and use those guardrails to try and navigate things going forward. Now, we don't have specific details. I mean, that press conference covered a lot of ground. How much discussion was there on what's going to happen with rare earths? That's a big US complaint. What's going to happen with export controls from the US side? That's the Chinese complaint, for example. It was interesting listening to Ambassador Greer make the point that it sounded like they tried to keep the conversation more or less on trade and on the Geneva topics. We know China probably wanted a more expansive conversation, but clearly the US wanted this focused on the merchandise trade story. So by all accounts, it sounds like the Geneva deal at the very least is back on track. Those tariffs will remain where they were. No language around a near-term hiking in those measures. And it sounds like they're both sides are looking for an off-ramp near term, but we just need to see what details are in this as it comes out over the days ahead, Sharon.
Yeah, and it was interesting that Secretary Bessent also wasn't there. Of course, we know that he had to go back to the U.S. for a hearing at Congress. We know that he's been seen as a contender for the chair of the Federal Reserve. How difficult could this job be in this environment when we also really have no certainty about these trade negotiations?
Yeah, well, it's a fast-moving environment here. I mean, he obviously is the chief economic spokesperson for the administration right now. And as you mentioned, our own colleagues in D.C. today were reporting that when it comes to the list of who might make the next Fed chair, Treasury Secretary Bessent has his backers both within and outside the administration. Now, the administration pushed back on that point. And of course, Secretary Bessent himself made a point he's already happy with the job that he has. It's up to the president to choose Fed chair. But it just adds to this idea that there's kind of ongoing, ongoing fast-paced moves in economic policymaking here right now. President Trump said last week that he's going to consider who will replace Chairman Powell at the Fed, whose term is up in May 2026. He's going to make a decision on who will replace him soon. So that gets you into the analysis of what names might be on the list. Now, to be clear, Chairman Powell is due to finish his term until May of 2026. So whoever gets named isn't going to be taking over the Fed near term, barring some kind of a major surprise. But clearly, big names are being talked about, the likes of Kevin Warsh, a former Fed official, and now, of course, Treasury Secretary Bessent. And who's to say other names won't be on that list as the weeks go by in the months ahead?
Yeah, at a time when there are expectations that this year the Fed will only cut once. And Curran, great to have you with us, Bloomberg's global economy correspondent there. We do have more ahead on the Asia trade. This is Bloomberg.
Well, the annual Morgan Stanley Australia Summit begins today with business leaders and investors gathering to discuss the broader economic and investment outlook. Let's get more with our first guest. Richard Wagner is the CEO of Morgan Stanley Australia and joins us exclusively today here on Bloomberg. Richard, always great to have you with us. And of course, you join us at an always exciting time as we get these trade developments, mostly positive in terms of US-China. Has that sort of played into the mood music for your business here?
Well, it's certainly seeing some positive news overnight. It's always a good backdrop. The reality is the equity markets have already voted that we're through the worst. We're back to near all-time highs, and we've certainly seen that in Australia with some very strong performance across the large cap stocks. And I think that's the market betting on the fact that the worst is behind us. We're going to see some more stability with the volatility decreasing.
How much has Australia also seen that, I guess, safe haven reputation play out?
We've certainly seen a lot of inflow from offshore. And I think particularly in April, when the market in the US was very spooked, we did see a capital flow to Australia as a safe haven. Some of those investors were obviously taking a bet against the US dollars, which has played out. And when you look at Australia, we have a good economy, We have a government budget that's in good shape. We have a lot of government spending. We have a new government or an Albanese government re-elected that has the ability to govern, and I think that's a good, stable base that has attracted global capital. Also, a lot of private equity capital pointed towards Australia. Given the volatility, we haven't seen that really come out yet, but it's waiting on the sideline.
Has some of that, particularly when it comes to deal-making sentiment, taken a pause?
Certainly the first 6 months of this year has been difficult on deal flow, but I think we're about to see that change. We've got the two largest IPOs in the market ready to launch in the next 2 weeks. Virgin IPO, where Bain Capital's done a great job with that business, and we're leading the Gem Life REIT transaction, which is also shaping up well. So I think we will see the IPO market open, and then M&A tends to be a more lagging indicator of confidence. Certainly the M&A pipeline is very strong in Australia, and I think that's a second half story.
Any particular sectors or areas of growth that you're targeting for Australia?
Look, in terms of Morgan Stanley, we've been waiting on the sideline to see the transaction activity return. We've had very strong performance in wealth management and in our institutional equities businesses as clients have repositioned around the global volatility that we've seen. But certainly deal volumes in M&A and ECM have been well below historical levels. And I think with the IPO market now open, those first two deals about to launch, that's a good backdrop for what will be a better second half for the investment banks.
I'm curious what you're seeing when it comes to activity for foreign transactions and foreign inflows, particularly from China as the economy obviously continues to rebalance and slow.
Well, certainly if you look at inbound transactions into Australia, historical M&A volumes have been about 60% offshore buyer. And the Chinese money was predominant about 5 or 6 years ago. It was the largest proportion of that foreign inbound investment. The last 3 or 4 years, we've seen that tail off significantly. And obviously, given the current geopolitical situation, we're not expecting to see that return in a hurry. But we're seeing much greater interest out of Europe and the US and Japan.
When it comes to the wealth proposition for Morgan Stanley here, what are the next steps to progressing that?
So Morgan Stanley's wealth business, obviously we're a global leader in wealth management and we've got a very large business in Australia. The business proposition for us in Australia is a high net worth business and it's offering something that's global to our clients. I think what we've seen with the volatility in markets over the last 4 or 5 months is unless you're global and unless you're plugged in, nothing happens in Australia that hasn't been caused by something offshore. And so our proposition to our clients and why we keep growing our wealth business is simply to cater for high net worth clients looking for a global product offering.
And when it comes to those ultra high net worth and high net worth clients, are you looking specifically at the sort of generational shift in wealth at the moment? How's that transition playing out?
That transition is active,
yeah.
And clearly the wealth creation in Australia is phenomenal, as evidenced by the strength in our property market. It is a destination of choice, and I think further to my earlier comments about a safe haven, Australia's emerged as a safe haven for wealthy people all over the world. And a number of our clients, many of our clients, are foreign nationals that have moved to Australia because they want to be here and they want to live in what is a safe and stable environment in Australia.
The government mandate coming out of the election result obviously in and of itself provides some sense of continuity. What would you like to see in terms of policy that would benefit the business?
Well, look, certainly I don't think we should turn the tap off on the immigration. I know we have the housing crisis that we have. The government has done a very good job of spending money and supporting our economy, and I think that will continue under the re-elected Albanese government. That underpinning of government spending in our economy has made Australia a safe haven. I think the market is voting that even if we do see a market downturn or a mild recession in other parts of the global economy, that we won't see that in Australia, partially because of our strong budgetary position at a federal level and the fact that our government can keep spending money. That's quite rare in the current environment globally. Most governments are under extreme fiscal pressure. We are not.
What are you seeing or planning when it comes to hiring? And are you seeing the sort of, I guess, the beneficiary side of Australia being more appealing given some of the brain drain or talent drain out of a US market, for example?
Look, we're not seeing a huge inbound flow of candidates at the moment. It's fair to say that in the investment banking industry, there hasn't been a lot of hiring in the last 6 months as markets have been so volatile. But we are expecting that to change in the second half. As we've seen IPO markets open in the last 3 weeks, once Trump paused those tariffs, we saw markets open in the US. Debt markets, IPO markets. We've priced a number of IPOs in the US. We're about to price a couple of large ones down here. And I think that will lead to a different environment for hiring people in the investment banking industry.
Is that a green light for you to start being a bit more bullish on adding staff?
Yes, and we certainly, I don't think any of the banks have added staff in the last 6 months. It's really been wait and see while the market volatility has settled down. We certainly would like to gear up as we see markets improve over the next 6 months and going into next year.
With regard to the 10 trillion client asset goal globally for Morgan Stanley, how do you see Australia fitting into that?
Well, look, Australia is the 5th largest pool of savings in the world, which is quite a phenomenal statistic given the size of the Australian economy. And Morgan Stanley, not only from an institutional and super fund perspective, but also a high net worth client, are very focused on capturing more market share in the Australian market, given that huge pool of savings. And importantly, most of our investors, be they institutional or high net worth, are already heavily invested in the Australian market. And so what they're really focused on is how do I deploy offshore and where should I be taking my bets? And so all of their focus is on global opportunity rather than domestic.
What are your growth targets for this market?
Well, I think the most important growth target for our market is seeing the M&A and IPO market reopen. Quite frankly, if we think about deal activity, the last 6 months has been quite horrible. There's been no IPOs, there's been only a few capital markets transactions. The debt markets have remained healthy, but what we really need is a return to more confidence on the M&A product, and we're certainly about to see that with the IPOs that are about to launch.
It's interesting, equity investors have kind of led that return to confidence, be it just they're a bit bored with the trade story and the back and forth, or there is this confidence that at least things may not go backwards, right? Do you think that's enough for you to have confidence to be able to see that as a catalyst for growth?
Heidi, that's certainly the case. The equity market today has voted that the worst is behind us because we're back to trading at all-time highs. Therefore, the market is already telling us that we can work our way through any further announcements that come out. We're seeing positive progress on the tariff negotiations. We are at a point where we're staring into an interest rate cut cycle, and therefore I think that confidence level is justified. And I just interviewed Dan Loeb from Third Point on the stage, and his overall thesis was that the US market has got another leg up from here.
What's your biggest risk in the next, well, let's say for the rest of the Trump presidency?
Look, I think it's been an unpredictable 6 months, hasn't it? So I think the thing we need to think the most about is what else is coming out that we don't expect. I believe that the market will look through and is already voting with its feet that it's looking through any daily announcements. It's already banked that we'll get through the tariff negotiations, and it's already back trading at high level. When you bring that back to Australia, probably the most important metric for me is the labour market. We've got pretty much full employment at the moment, unemployment sitting in the 4s, which is a great level. And if that remains at that level, I think we'll have a greater level of confidence in Canberra around continuing to spend. We'll see interest rate cuts, and we won't see inflation.
Richard, great to have you as always. Richard Wagner, who's the CEO of Morgan Stanley Australia. Shery, pretty positive way to end that conversation.
Yeah, Heidi, I mean, given right now the backdrop, of course, with the trade negotiations ongoing in London as well, seeing a little bit of positivity. This is the picture across markets in Asia as we set up for the major market opens. We're seeing a little bit more upside when it comes to the offshore yuan. Not surprising, given that we have heard that some sort of consensus has been reached on that framework that was achieved back in Geneva last month. So now the issue has been implementation, and Commerce Secretary Lutnick saying that President Xi and Trump have given the fundamental foundation to move this forward. report, we are now seeing the dollar-yen actually rising a little bit or falling a little bit. So a little bit of weakness in the Japanese yen, a little bit of more risk-on sentiment, sort of move away from safe havens, perhaps, at a time, of course, when we're also watching U.S. futures, which pop a little bit higher earlier, right now unchanged. But this, of course, as we have the S&P 500, less than 2% away from its peak record high back in February. But let's bring in senior FX and rates reporter Ruth Carson, as well as our Asia equities reporter Winnie Su. Ruth, let me start with you, because we have seen a little bit of a pop in the Chinese yuan. Could we expect more upside given the optimism right now?
Absolutely. Great question. And it's important to remember that currencies, because of their liquidity, tend to move ahead of virtually every other asset class when it comes to big news in markets. But the fact that movements have been so little, quite muted, suggests that traders are just going, and now what? So basically, there's a sense of they need more concrete evidence of progress in trade talks, in negotiations, in understandings between the US and China for more conviction in trades higher. Yes, absolutely. We've seen a slight pop higher in the yuan. We've seen a slight dip in the yen, which is the traditional safe haven. But look, for these moves to stick or gain momentum, we'll definitely need more headlines. There's still a sense of wariness among FX traders everywhere.
Yeah, Ruth, to be fair, really not fair to be asking you where the yuan is headed when there's so much currency volatility at this point. But Winnie, that's been the case with equities as well, because Chinese stocks actually fell in the previous trading session because there were some concerns that these negotiations weren't going well.
Right, Shery, it seems like there's more volatility in the equity market compared to what Ruth is observing. And that's, again, mainly driven by kind of how the headlines are just something that people are really gripping onto right now. So like you mentioned yesterday, such a volatile session in the Chinese market was up quite a lot because of that optimism for the trade talk, and then dipped further because we saw in China that there are these news or these information coming in that trade talks might not be going as well. However, overall setup today for Asia as well as the Chinese market is still quite positive, seeing that positive U.S. session overnight translating through. And now we do still see some of the more positive tone coming out from both China and U.S. But like Ruth mentioned, it's still more on the cautious end. You saw that S&P, the futures for S&P actually popped up a little, and now it's back down. So the overall, I think people will be still monitoring for more details to come out of the trade talks. And that's still what we'll be watching throughout the day.
Yeah, Winnie, because when I look at the equity space in Asia, it's really interesting that we've had 2 sessions of gains, but we're already at the highest level since, November of 2021. What's driving these gains, and who are the biggest winners?
Right. So, like you mentioned, it's just kind of like a slow grind towards the upside. And MSCI Asia is now trading at the highest since 2021. And with China, the HSCI and also MSCI China both entered a bull market just yesterday and the day before. So really, the sentiment is picking up around how there would be a de-escalation between U.S. and China. And when we look at the biggest gainers, right now, we're still seeing HSCI being one of the top gainers among Asian peers. And that's, yes, driven by kind of the macro environment getting better, but also we're seeing some other the individual factors, whether it be the strength in the biotech sector being the top performing sector in the Chinese market. And also people looking at the new consumer or new consumption space, saying that they are looking for opportunities that are less affected by the tariff headlines, and hence those are really driving the gains in those sectors as well.
Ruth, when it comes to the Japanese yen, I really have no idea where it's going, because we're talking about a more risk-on sentiment, which usually means a little bit more weakness in the Japanese yen. But just last week, I was talking about Nomura Holdings calling a 136 against the dollar.
Yeah, absolutely. And it's fair to say that forecasts in many aspects are all over the shop, depending on who you speak with and where they are located. Dollar yen in particular, even euro yen, is heavily in focus. We have to remember that the yen is the world's third most traded currency in a $7.5 trillion a day foreign exchange market. And given that Japan is home to the steepest yield curve in the developed market world, it is so heavily traded, the yen, and investors we've seen, get really burned by the carry trade in August and stuff. Everyone is trying to figure out exactly where the yen is heading. Now, I've spoken to people who've said 135 or 130 by the end of the year, especially if interest rate differentials do compress with the US. Others say, look, you can't rule out 150 and higher, if things really progress on the trade talk front. So really, take your pick on the day, Shery, on where the yen is heading. But definitely we're going to see a lot of trading ahead, especially during the Asian session.
It's really difficult for me at this point to be exchanging my yen to dollars because I have no idea where it will be in a few days. But long end yields, Ruth, before I let you go, because JGB yields on the long end have been rising. Of course, we do have Treasury auctions this week as well. What are the key drivers and what are we watching in the days ahead?
Yeah, it's absolutely incredible how a couple of months ago, if anyone had said long bond auctions, you go, you're not really of importance. But here we are, Japan being at the epicenter, as we've seen in the last couple of weeks, of global volatility that spilled over to treasuries, gilts, euro bonds. And look, yeah, we've seen the 30-year auction last week, weakest demand since 2023. But look, we do have another very important pressure point here coming up on Thursday. US Treasuries 30-year auction. If that goes badly, be it demand or whatever it might be, expect more volatility to rip across markets, including a spillover into the Asian session.
Ruth Carson, always good to talk to you. Bloomberg's Winnie Su also joining us at the Morgan Stanley Summit, speaking exclusively with the bank's Australia Wealth Management CEO. We also get reaction to the latest U.S.-China trade agreement with Morgan Stanley's head of macro strategy. This is Bloomberg.
Let's get you more now from the Morgan Stanley Australia Summit, where business leaders and investors are gathering to discuss the broader economic and investment outlook and all of the related volatilities. Rebecca Hill is the Australian Wealth Management CEO for Morgan Stanley, and she joins us now. Really great to catch up with you, particularly at a time where volatility, uncertainty, but also sort of cautious optimism is creeping back into the narrative. What are clients sort of broadly worried about or interested in right now?
Thank you, Heidi, and thanks once again for hosting us here at the Morgan Stanley Australia Summit. Our clients, as you would expect, are very much focused on the US, what's happening in terms of US policy changes and how that's going to impact the economic outlook and geopolitics. So we're having lots of conversations around fiscal outlook, the US dollar, and what the implications are for their portfolios. It's very much now turning to longer-term thinking about how this plays out. Clients are very resilient. They've been through market cycles before. So they're thinking about, well, how do I best position for this cautious optimism that's now creeping into markets?
Where is a lot of that interest being directed towards? Obviously, we were just speaking with Richard earlier about how Australia's really benefited as being, a safe haven market in these times.
Yeah, absolutely. And look, I think the investors are thinking more around private market investments in these times because they are traditionally less correlated with market movement. So we've seen a huge growth in private market investment in Australia. It's up 161% over the last 10 years. And that's the conversations a lot of clients are having with us is where to invest, what we think is a favourable asset to invest in. And, our preferences at the moment, given current markets, are hedge funds, infrastructure and private equity. And we think they're good investments in the current environment.
I was going to ask you about that mix because obviously that private market interest or trend has been ongoing for a while. Do you see that as kind of being a sustainable direction?
Absolutely. I think we all see the diversification benefits that come with that. I mean, it does very much depend on the individual investor and their risk profile and investment horizon, but having a mix of that traditional assets, so the normal equities and bond mix, plus the alternative investments is just maximising diversification in your portfolio.
Is that also happening as we see the generational shift, not just in Australia, but really across Asia when it comes to some of these wealth portfolios?
Absolutely. And, you know, a lot of the conversation we're having with families now, wealthy families, is about that intergenerational wealth transfer and how they best transfer wealth and their values to the next generation. So we're having conversations around legacy planning, philanthropic structures. I think it's now 54% of high net worth investors are looking to give some of their wealth outside of the family, so leaving it to charity. So they're engaging with the younger generation around the giving strategy, and that's often their first introduction to wealth and wealth management.
Are you setting sort of more goals when it comes to growth in the business, including staffing and advisor numbers?
Absolutely. I think, you know, the Australian environment, high net worth investors continue to grow. I think it's at 9% year on year in terms of that pool of wealth. So it's a very attractive landscape for wealth management firms, and we're fortunate to be one of only a couple of truly global wealth management firms in Australia. So we are continuing to look to hire. We want to hire the right advisors to be part of our longer term vision for the business.
And there's robust competition or healthy competition when it comes to battling out for top talent. What's your approach there?
Look, we are fortunate to have such a strong brand in Morgan Stanley, the wealth DNA within the firm. You know, we're the largest global wealth manager, so that really helps attract top talent. I'm biased, and I think we have the most skilled advisors in Australia working for Morgan Stanley. So, look, there is, as we all know, not enough advisors to service all the needs in Australia, and there's definitely different client segments. So there's a place for everybody, whether it's, you know, a global firm like Morgan Stanley or one of the more domestic firms to service that market.
We talked a little bit about private markets, but where are you seeing otherwise the biggest growth opportunities within wealth?
I think it's really around that philanthropic and legacy planning piece, so helping clients think through that. I mean, we've obviously got some changes being proposed by the government around superannuation and taxes of the $3 million plus superannuation balances. So talking to clients, helping them work through those tax strategies and how they may approach that if that legislation is passed is also part of our conversations at the moment.
When we spoke back in December, we talked about the rollout of AI technology and tools, right, as part of how these portfolios are managed and how value is being added. Has that accelerated in terms of how that's being rolled out? Australia was a little bit behind compared to other regions in that.
Yes, I mean, we see AI and technology as a huge enabler to our business, and particularly on the wealth management side. A lot of the tools that we're developing are internal based, so focusing within Morgan Stanley to increase productivity and efficiency, particularly for our financial advisors. What we have here in Asia and Australia at the moment is this fantastic tool called Ask Research, which is it's generative AI that's backed by OpenAI's GPT-4 technology. Effectively, it allows the user to put in their own prompts to search all of our 80,000 plus research reports and just try and summarise and really drill into the key insights and help us kind of drive our day in a lot more of an efficient way.
Rebecca, really great to chat with you as always. Rebecca Hill is the CEO of Morgan Stanley Wealth Management here in Australia. We do have much more ahead in terms of conversations from the Morgan Stanley Australia Summit. We'll be bringing you an exclusive conversation with the bank's global head of macro strategy, Matthew Hornbach, for his reaction to the latest US-China trade agreement. Also looking forward to his insights when it comes to what's going on with the JGB and Treasuries market at the moment. That's coming up. This is Bloomberg.
The offshore yuan paring back some of those earlier gains that we saw, Haidi, when we heard the comments coming from Secretary Lutnick, not to mention USTR Greer, when it comes to China and the U.S. Sort of reaching a framework of understanding when it comes to the implementation of that deal that they agreed to in May in Geneva. But Haidi, really a lot of questions of what that actually means. Didn't they already have a deal? They were trying to explain that, yes, but sentiment had soured. Sentiment is better now, so they're going to try to actually implement it. What's on the table? We've been speculating a lot. It seems to be the rare earth shipments to the U.S., removing certain measures targeting exports from China, but still a lot of clarity left for policymakers to really announce at this point as they're taking these conversations of 2 days in London to Presidents Trump and Xi Jinping, and then we'll see what we actually get out of these conversations if there's anything concrete.
Yeah, and you said it, Shery, the lack of details is really what we're waiting for. It feels like equity investors at least have kind of, made their minds up already, right, that they were expecting positivity or at least no regression when it comes to what was agreed in Geneva. And now they've gotten sort of some niceties from either side, right? But we're just getting some kind of reaction when it comes to the markets at the moment. National Australia Bank, NAB for one, come out and saying the devil is going to have to be in that detail, particularly when it comes to what we see with some of the pro-cyclical currencies like the Aussie dollar, the Kiwi, as well as what we're seeing for dollar yuan as well. So we continue to see that there are expectations that this needs to be more than just a handshake agreement.
This is the Asia Trade. We're counting down to Asia's major market opens as the U.S. and China have just agreed in principle to a framework for de-escalating trade tensions. Those conversations in London, we got confirmation, Haidi, also from China's side, the trade negotiator Li Chenggang, talking about hoping that this progress will be conducive to building trust.
Shery, the question is whether this kind of near-term positivity will give way to further expectations that we're going to need more details. NAB, with its note reacting, saying the devil is going to be in the details. We're going to need to see that this is more than just a handshake agreement because, let's face it, that's what we thought we got back in Geneva, right? So where are the details when it comes to rare earths and tech curbs and the other things that we were expecting to be broadly discussed in these 2 days of talks in London? But we are expecting that broad positivity, at least in the short term.
Yeah, we're seeing that cautious optimism even in the markets right now because we're seeing small gains for the Nikkei and the Topix up 0.3%, while the Japanese yen, with this more risk-on sentiment, is now holding steady at that 144 level, but very close to 145 against the U.S. dollar. Remember, it's been seeing a little bit of weakness given the optimism and positivity that we're sensing from the China trade negotiations with the United States. But of course, given that we still have to see a little bit more details on that, we're still watching the offshore yuan also, which is giving back some of those earlier gains. Take a look at how the Kospi is also coming online because we had seen significant strength for Korean assets recently. We are getting the latest when it comes to the first 10 days of trade for the Korean economy. Exports rising in the single digits, only 5.4% year on year. When it comes to imports, rising 11.5% year on year. The Kospi had gained ground. We're talking about more than 4% last week on the election of President Lee Jae-myung. We're seeing a little bit more strength on the Korean won, up 0.2%, and the Kospi also coming online to the upside. Take a look at what Australia is doing because we had seen that optimism already, seeing some gains for the Australian dollar, also for the Kiwi dollar. We continue to watch the 10-year yield as well in the U.S. Of course, we have seen the Treasury space holding steady this past week, but we do have 10-year auctions and 30-year auctions as well that we need to contend with. The ASX 200 up 0.2%. But let's discuss what's happening in global markets with Ken Wong, Asian equity portfolio specialist at Eastspring Investments. Ken, always great to talk to you. Let's talk a little bit about China first, because I mentioned earlier that the offshore yuan has seen a little bit of a boost earlier when we actually saw some positive comments from trade negotiators in London, giving up some of those gains. How are you positioning in China?
Yeah, at the moment, we still have a very strong focus around IT and specifically around consumer-related products, in particular around the tech space. So along that lines, we still see fairly strong, robust earnings growth coming from, communication services, plus, as I mentioned earlier, a lot of the hardware sectors. So that's kind of how we want to look at positioning. The focus, again, is still going to be more focused on the more domestic-related type of plays. Still, given the fact that, there are a lot of news and, sort of updates in regards to potentially having more progress around trade, we're still a bit skeptical. So until we find more details in terms of how things will play out, we're still going to take a bit more cautious approach in terms of positioning our portfolios.
We've seen diverging views when it comes to Chinese tech. Some like it, some think that it's not worth getting in this early. What are your thoughts?
No, really focusing on earnings. The fact is that we want to look at things from a bottom-up perspective, is really to look at overall earnings growth perspective, potentially where the markets potentially have things priced a little bit maybe below their intrinsic value. And this is really kind of where we're looking at. If you look at over the past 4 weeks or so, and when you look at overall earnings revisions, and when you look at those more positive sentiment coming from these earnings revisions, it really has been coming from the IT-related names as well as some of the more consumer discretionary tech-related names and consumer and communication services companies as well.
Ken, what are your worries about the consensus trade and expectations with the US dollar? We're even seeing that play out, of course, in reaction to US-China trade progress is really benefiting the yuan versus the greenback.
Yeah, our belief is that right now, when you look at, and again, when you talk about with consensus, the belief is that the U.S. dollar will continue to weaken, sort of as we approach the summer months. But the fact is that a lot of times when you have this consensus trade, and specifically with a lot of negative around the U.S. dollar, things don't always pan out the way that they do. And so there is potentially some concerns there that potentially, what if, let's say, the U.S. economy continues to have solid numbers, and let's say specifically, unemployment numbers in the U.S. continues to be at low levels, then potentially, the fact is that the U.S. dollar might not weaken as much as anticipated. Again, that is potentially, sort of what everyone's thinking. But at the same time, I think a lot of people are focusing really on Asian central banks, and in particular, the policies that they're trying to implement in regards to, how much further they can lower interest rates, because we've already seen that with the RBI on Friday, lowering interest rates a little bit higher than anticipated.
In terms of other emerging markets, you also quite like India right now.
Yeah, overall, when you look at economic growth, the economic growth story remains to be very solid. Overall, when you look at the inflation numbers, they continue to trend downwards. And as I alluded to earlier, with that 50 bips of rate cut that we saw back on Friday, and potentially maybe we might even see another further rate cut maybe a couple months down the road, that does lead to some potential there. And in particular, when you also look at the large cap space amongst Indian stocks, the fact is overall valuations have come down quite a bit since their highs that we saw towards the end of last year. So there is definitely a lot to like when it comes to India, especially when investors are still continuing chasing for growth opportunities in this part of the world.
How does the Japan story compare now that we're seeing more weakness in the yen as well?
Overall, when we look at specifically what's happening in Japan, we're more focusing really on overall earnings growth. The fact is that when you look at the earnings growth momentum that we're seeing in Japan, the fact is that it's outpacing specifically what we're seeing right now when it comes to overall Japanese market performance. So with earnings growing stronger than what overall market performance has been, we still expect to see potentially, especially amongst developed investors, where they're focusing a bit more of their reallocation, especially if they are moving a little bit away from the U.S. or potentially from Europe. Japan definitely looks to be a place for investors, regardless of kind of where that yen position is, because right now with the yen, it seems to be a bit more of a range-bound position. So with that in mind, investors aren't really focusing as much in regards to, sort of any potential large swings amongst the Japanese currency. The belief potentially is going to be on earnings growth, and in more particular, what is the BOJ going to do when it comes to interest rate policies? Will they have time potentially for maybe another interest rate rise later in the year? Those are some of the potentials, but we're looking for that. We're looking for potentially whether or not we can see further economic growth, especially amongst the consumer areas. Those are really going to be sort of areas that we're going to look at when it comes to Japanese equities.
Especially at a time when we're headed towards another upper house election here in Japan, we have seen Prime Minister Ishiba making promises. They want to increase the average pay by 50%, working towards a 1 quadrillion yen economy, that's $6.9 trillion by 2040. But suffice it to say, the political background here and the backdrop in Asia has been changing. Same thing with South Korea. And it seems a lot to do with more fiscal spending, stimulating the economy through consumers, through really paying out the general public to help with the accelerating inflation picture. Are there any economies where you're particularly following that for perhaps some upside in the retail space?
Yeah, again, this is across Asia. The fact is that when you look at overall Asia consumers as a whole, and when you look at prices here in Asia, prices continue to fall, right? Overall, inflationary pressures is not that high here in Asia. And so, as you mentioned earlier, we have very strong fiscal policies being implemented across the board here in Asia. But more importantly, what are going to be some of the more accommodative monetary policies, again, further loosening of interest rates across the region? Those are going to be important aspects. And, coupled with the fact that potentially, we will continue to see further appreciation of Asian currencies, which should help as well. So when you combine fiscal, monetary policies, and specifically, further rise in terms of economic growth and low inflation, this is one of the key reasons why we continue to like the Asia region, because of all these opportunities that the region presents itself right now. And overall equity market valuations aren't really that demanding right now across the board here in Asia, with the exception of potential where India. But even with India, valuations for stock markets there are roughly around 20 times earnings now. So there is definitely a lot more opportunities now. And we, as bottom-up investors, are definitely looking at opportunities across the board here in Asia.
Ken Wong, good to have you back. Asian equity portfolio specialist at Eastspring Investments. We have more ahead on the Asia trade. This is Bloomberg.
We have reached a framework to implement the Geneva Consensus and the call between the two presidents.
The relationship is complex. There are challenges that can't be eliminated in a couple of months, of course, but there are things we potentially could do. So, I just think we feel positive about engaging with the Chinese, understanding the real challenges.
US Commerce Chief Howard Lutnick and US Trade Representative Jamison Greer, they're speaking about the trade talks with China. We also had a broadly positive update from the Chinese side as well. Let's get more with our Chief North Asia Correspondent Stephen Angle in Hong Kong. We're getting that reaction through in the markets, but also some reaction from analysts. NAB, for example, saying the devil is going to be in the details, of which are pretty scant at the moment, Steve.
Yeah, I think so. But it was a positive sign that the first indication that the talks went well came from the Chinese side. So the Vice Commerce Minister Li came out and essentially saying that they had reached a consensus and that they hope the progress is conducive to building trust. The teams will then report back to their respective leaders. That was from Li Changgang, the Vice Minister of Commerce. Then shortly after, that man right there, Howard Lutnick, as well as the U.S. Trade Representative Jamison Greer, did meet with the media, basically saying the similar thing, that they've reached agreement on the framework that was achieved 4 weeks ago in Geneva in that truce, where China agreed reportedly to let the rare earths licensing process speed up and get those rare earths and those rare earth magnets to the United States in greater numbers. And the United States then potentially could also then reel back some of those additional export controls that happened over the last month. Now, here is the crux of that little press conference, the scrum, as we call it, on the steps of Lancaster House in London, just after midnight in London time, after 2 full days of talks. This is what Howard Lutnick had to say about whether rare earths are included in this reaffirmation of the framework from Geneva, and what it would mean about rolling back potentially those U.S. export controls that came subsequently. Here's Howard Lutnick.
We do absolutely expect that the topic of rare earth minerals and magnets with respect to the United States of America will be resolved in this framework implementation. That is a fundamental part of that. Also, there were a number of measures the United States of America put on when those rare earths were not coming. You should expect those to come off sort of, as President Trump said, in a balanced way. When they approve the licenses, then you should expect that our export implementation will come down as well.
Those export implementation measures that he was just talking about included chip design software, jet engine parts, chemicals, and also nuclear materials. No specifics really right now on what needs to be hammered out. This agreement that was reached at Lancaster House in London now goes back to the respective leaders. If they sign off on it, then the working groups can get down to the nitty-gritty on the details and the specific items and deadlines and the like. Keep in mind, and that Geneva truce, that essentially brought down the tariffs that the Trump administration had imposed on China down to 30%, 10% baseline plus 20% for the fentanyl issue. The fentanyl issue is still being discussed, but that's probably the next phase, whether China can make the necessary steps that the U.S. requires to remove that excess 20%. Now, there's a deadline. Keep in mind, I believe it's August 12th, mid-August, for this truce to last. Now, this is a good positive step to potentially extend that deadline, that truce, that pause on tariffs. We don't know. Again, that's in the details. But there are other nations as well that are scrambling and racing to try and get a deal with the White House ahead of their deadlines. Keep in mind, July 19th, thereabouts, or coming up next month is the deadline for other trading partners like India, South Korea, Japan, and others to reach some sort of trade deadline. Otherwise, those reciprocal tariffs will go back to where they used to be.
Yeah, I think for other countries it's July 9th and mid-August, as you mentioned, when it comes to the China trade tariffs. But I'm seeing some hot headlines right now on the Bloomberg. Trump tariffs can stay in place longer. This according to the U.S. Appeals Court. Remember, there had been a lot of legal battles and issues in the United States, given President Trump's tariffs. Of course, Steve, you just talked about the Appeals Court will hear arguments on these tariffs on July 31st. Federal Circuit Court will be hearing the tariff appeal on a very fast timeline, but for now, those tariffs can stay in place longer. And Steve, as we're discussing, I mean, we were talking about tariffs, we were talking about export controls, but you said it, it's the nitty-gritty, right? And the scope of the nitty-gritty seems to be so much wider than before. Tell us a little bit more about these new trade weapons that both sides are using that needs to be dealt with.
Yeah, absolutely. Well, China in this trade war has found that it perhaps has more levers, of course, than just like-for-like trade numbers, because it does not import from the United States as much as it does export. But again, the rare earths is the nittiest of the nitty-gritty, if you will, the most important issue for the United States because of these rare earth magnets and rare earths, which China controls about 70% of the world's production of these rare earths, 90% of the key, very niche rare earths that go into magnets that have high, they retain their magnetism in high heat environments. That's why it's critical to the aerospace as well as the defense industries, and China controls about 90% of that production. So this was critical for the United States to get an agreement. The framework of the agreement, the nitty-gritty will come later in working groups and further talks, but to make sure that China does have the process in place to expedite those export licenses for those critical rare earths to get to the United States. Now, the other side of the coin is the United States also must pledge the Chinese have been demanded, get rid of these tariffs, or at least extend the pause on the tariff increases, and also remove those latest measures that were implemented because of what was perceived to be a violation of the intent of the Geneva Agreement. That is something, as we heard just a few minutes ago, Howard Lutnick says, if China does expedite the exports of those rare earths, the United States would act in kind to potentially remove those export limitations to the Chinese.
Right. Our Chief North Asia correspondent Stephen Engel there with the latest on the U.S.-China trade negotiations and, of course, those trade weapons that are being used by both sides at a time right now when we're seeing the latest coming also from a U.S. appeals court saying that President Trump's tariffs can actually stay in place longer. The ruling on whether to keep most of these global tariffs in place after we saw that pause on the lower court's May 28 ruling that most of President Trump's tariffs are actually illegal. So right now, the administration is arguing that allowing the tariffs to be blocked would actually harm the president's ability to conduct foreign policy. You can see not a lot of movement in the markets right now, but this after we already saw the S&P 500 gain ground in the overnight session. We're about 2% away from its February record high. NASDAQ 100 futures not doing much. But we saw some upside when it came to more positive sentiment around the trade negotiations with the offshore yuan gaining a little bit of ground. So the tariffs now likely to endure for months while the court weighs on the argument presented by President Trump's administration and, of course, a lower court as well. Other stories that we're following at this hour, the U.S. and Mexico are set to be close to a deal that would remove President Trump's 50% tariffs on steel up to a certain volume. Sources say U.S. buyers would be allowed to import Mexican steel duty-free as long as total shipments are below a level based on historical trade volumes. Commerce Secretary Howard Lutnick is leading negotiations, but a deal would still need Trump's approval. His administration will propose scrapping Biden-era climate mandates requiring power plants to curb greenhouse gas emissions. Sources say the Environmental Protection Agency is also planning to unwind limits on mercury and other toxic air pollution from the facilities. We're told the aim is to prioritize domestic energy development amid a surge in power demand from AI. At least 19 bomb blasts have rocked southwest Colombia just days after the attempted assassination of presidential candidate Miguel Uribe. Police say at least 4 people were killed. Attacks included an explosion near a police station in Cali, the country's 3rd biggest city. The government blames what it calls international mafia for both the bomb attacks and the assassination attempt. NATO allies are considering allowing contributions to Ukraine's defense in the new spending target to be adopted at a leader summit later this month. Sources say Secretary General Mark Rutte is seeking to keep the U.S. fully engaged by getting member states to allocate at least 5% of GDP for defense spending. Trump has said he'll attend the summit in the Netherlands. We have more ahead on the Asia trade. This is Bloomberg. Bloomberg has learned that Treasury Secretary Scott Bessent is emerging as a serious contender to succeed Jerome Powell as the next Fed chair. Powell's term ends in May of 2026. For more, Bloomberg's global economy correspondent Enda Curran joins us now from Washington. And of course, he's been playing a crucial role in the U.S.-China trade negotiations, but his star seems to be rising even further. He could potentially become the Fed chair?
Well, he really is the principal salesman for the president's very fast-moving economic policy, taxation, the trade talks that you spoke about earlier in London tonight, for example. And yes, now some discussion that he could be in the frame for the Fed position. Now, to be clear, the backstory here is that Chairman Powell's term is up in May 2026. President Trump obviously has been publicly critical of Chairman Powell for not bringing down interest rates fast enough. And he recently said that he's going to appoint the successor to Powell at some point soon. And that's kind of lit up the discussion around who might replace him. And our colleagues here in Washington, D.C. are saying that both inside the White House and outside, Secretary Bessent's name is being floated as one of those that could. Now, there are others, obviously. You know, you have former Fed official Kevin Warsh, a very established economist, would be in the mix among some other names. The White House pushed back on the idea that Secretary Bessent could be in the frame for the Fed job. And of course, Secretary Bessent himself said he already has the best job in Washington, D.C., and it's up to the president to decide. But, you know, so it's clearly probably somewhat early still in this process, but there's a lot of scrutiny now on who might be on the list. And obviously, these are some of the top names that are appearing on it.
It's funny that he considers the best job in Washington being actually negotiating with China. I mean, he's at the center of these talks. He had to leave London a bit earlier for congressional conversations. He has a hearing. What are we expecting there?
Yeah, well, it goes back to the huge policy agenda that Secretary Bessent is trying to steer through. He's just left those talks, like you mentioned, Shery. Tomorrow morning, DC time, he's on the Hill at the Ways and Means Committee in the House. And that's the all-important committee behind the One Big Beautiful tax bill. That's expected to be a heavy discussion on fiscal policy, where the tax bill is at, what it can be expected to contribute to the economy. So a lot of focus on his remarks tomorrow, I think.
Bloomberg's global economy correspondent Enda Curran there joining us from D.C. And let's get some of the market calls that we're following today, because an interesting one came from PIMCO, planning to favor global bonds maturing in 5 to 10 years while staying underweight on long-term debt over the next half decade. The bonds giants annual outlook warns that a fractured global order marked by shifting trade dynamics and rising deficits will fuel persistent volatility. Let's move on to the next call. Morgan Stanley interest rate strategists say a surprise ebb in U.S. inflation data due Wednesday and declining oil prices should reel in the bond market's expectations for inflation over the next 2 years. They're advising clients in the inflation swaps market to prepare for the expected rate over 2 years to fall back below the 10-year equivalent of about 2.48%. This is Bloomberg. We're seeing upside across markets in Asia. We're talking about the MSCI Asia Pacific at the highest level since 2021, and the Kospi seeing another solid day, gains of more than 1%, highest level since January of 2022. We're talking about 6 days of advances for the Korean stock market. The Nikkei is also gaining about 0.5% as the Japanese yen is holding steady at that mid 144 level, 145. A lot of weakness against the U.S. dollar in recent days. We heard commentary from the BOJ Governor Ueda as well, talking about having little leeway in terms of stimulating the economy. They will hike rates again when they see the price trend actually consolidating. The ASX 200 also gaining about 0.5%, Haidi on the day. But of course, we have a little bit more positive sentiment coming from the U.S.-China trade negotiations in London.
Shery, Pictet Wealth Management's Hui Young Go says clients are increasingly looking to Asia, particularly as we continue to see the volatility play out in the US, really questioning US exceptionalism. But Blue Owl's Johan Santa thinks that investors should never bet against America. They spoke with us exclusively at a Bloomberg Invest panel in Hong Kong.
I've learned in 19 years being here in this region and affiliated to Wealth, there's first and foremost always a home bias. That's true probably for every market. But other than the home bias, US is a real large overweight in every client's portfolio. And while we see conversation for clients obviously shifting to Europe, and there are definitely great opportunities, Japan, India, other markets, it's literally impossible whether you are focusing on public markets or private markets to ignore the US. So, and one thing I also learned, never bet against the US and never bet against the US dollar in these 19 years here as well. So there is momentarily arguably shift, and from an asset allocation perspective, I think it makes all sense. But when it comes to scalable solutions, when it comes to finding opportunities, again, like truly scalable, which have an inherent element of protection implemented as well, it's hard to ignore the US in all honesty.
I'm going to ask you both this question too, but I'll make Hui Young really focus on it first. I think this is one of the harder questions because you have India, you have Japan. There's so many areas with so much promise. Which is the favorite among your clients?
In Asia or just globally?
In Asia.
Well, it really depends on where the client is. You know, if you just look at China, right? Valuation has come off. Is this actually a good opportunity? But for non-Chinese clients, they may think twice because of exit. It's not quite proven. Challenges in navigating that. When you look at India, I think there's a lot of buzz, there's a lot of startup, a lot of innovation, there's a lot of entrepreneurship. But the exits, well, there has been some exits, but I guess it's not quite very well proven as yet. So to be seen, valuation is also quite intimidating. And when you look at Southeast Asia, I think it's really depending on your cup of tea, right? Southeast Asia, some people say that it's not shallow. Some people think that this is a great opportunity because, you know, on the one hand, people talk about deglobalization. What's the opportunity when you have deglobalization? You talk about regionalization, right? So ASEAN is actually a big opportunity as well. But I just want to extend beyond that. So Johan talked about U.S. Undeniably, U.S. I think it's a very big economy not to be invested in. A lot of clients are overweight there. So clients, some of the clients, we're seeing that, you know, they're thinking about maybe dialing down because they're so overweight in there, right? So where can you dial it down? Well, if you're comfortable in Asia, there's a lot of opportunities, but it's very fragmented. Again, one needs to be careful because the rule of law is not the same everywhere in Asia. And then you have to deal with foreign currency, right? Do you want to hedge? How do you hedge?
Yeah, you were listening to Blue Owl Senior Managing Director John Santoro, as well as Pictet Wealth Management Head of Alternative Investments Asia, Hui Yang there. And it's day 2 of Bloomberg Invest Hong Kong, where leading investors, deal makers, and economists are discussing how to navigate the current market uncertainties. The China show will be there too, bringing you exclusive live conversations. Co-anchor Yvonne Man is at the conference venue. And Yvonne, you have an important conversation coming up with Hong Kong's finance chief.
Yes, lots to talk to with Paul Chan, Shery, with David Ingles. He's going to be sitting on the stage there pretty soon. But, you know, it's really going to be about all those headlines that you guys have been covering here for the past few hours or so. That federal appeals court in the U.S. Extending that pause when it comes to Trump tariffs. So they will be staying in place for longer on the back of what was very, very good, according to the U.S., talks with China on day 2 in London. So, you know, the trade negotiations are really going to be most dominant in terms of topics here today at Bloomberg Invest Hong Kong. And Paul Chan certainly is going to be the one we need to ask him about really what this means for Hong Kong, because in some ways the city has been benefiting from simmering tensions between the U.S. and China. We're talking about bull markets here in Hong Kong. And then again, also IPO markets are really making a comeback with a lot of Chinese firms seeking secondary listings or raising money here in the city. And as Stephen Roach just told us a few weeks ago, Hong Kong may not be over just yet because of this dichotomy that we're seeing.
Yeah, how its future is being shaped right now as the financial hub that it was in Asia for the longest time, right? So all of these conversations, what other guests do you have coming up that viewers should be watching out for?
Yeah, Paul Chan certainly is the big one that's happening in about maybe 40 minutes or so. Also, when it comes to really the outlook when it comes to the Chinese economy, right? So we have Morgan Stanley's Robin Shing. Hao Hong is going to be joining with a great panel there with Rebecca Chung-Wilkins and Stephanie Flanders, and really talking about the outlook for the Chinese economy in the face of all these external threats. How to invest, right? When the U.S. is no longer the reliable global trade partner, you have this sort of talk and doubts about U.S. exceptionalism. What does that mean? Where are the opportunities? We're going to be asking Steve Bryce from Stanchart as well. And then we're going to focus on private equity, right? Matthew Michelini from Apollo, he's been talking a lot, I know with you, Shery, about the opportunities in Japan. He's going to be joining Shanali on stage here to talk about that credit boom that they're seeing in Japan as well. And to wrap things off, we're talking about India wealth as well with Sunil Rahal-Kalei.
Yeah, private equity, really a big conversation here in Japan as well, across Asia with the new opportunities in that market. Yvonne Man, anchor of the China show, of course, at the Bloomberg Invest Hong Kong conference today. We have more ahead on the Asia trade. This is Bloomberg. Treasury is gaining a little bit of ground early in the Asian session. They've been pretty steady the rest of the week. This given, of course, we are just ahead of the May CPI data out of the U.S., not to mention a 10-year note auction, also 30-year auction as well. Really broadly speaking, yields on long-term global debt have soared in recent weeks, especially here in Japan as well, with long-end yields also continuing to rise and presenting new challenges for policymakers here. But Haidi, of course, will be discussing all of this with you at the conference in Australia as well.
Yeah, that's right, Shery. I'm here at the Morgan Stanley Australia Summit in Sydney. We're joined by the bank's global head of macro, Matt Hornbach. Is really great to have you with us, particularly at a time where there's growing anxiety when it comes to US Treasury markets, growing anxiety when it comes to the long end of JGBs. We have vague signs of positivity when it comes to US-China trade. What are you focusing on, and where do you think this trajectory is going to head? Does it get worse before things improve?
Well, thanks for having me on the program, Haidi. I do think that we are still in an environment of heightened uncertainty, even though it does seem like there is progress being made on some of these individual trade deals. I think investors broadly are still very uncertain about the final destination. That's what I'm hearing from investors around the region is, where is this going? What are the goals of the U.S. administration? What are the strategies that they're using to achieve those goals? And then the tactics around those strategies. I still think investors in this region and all over the world are still uncertain about where things are going.
Yeah. There's other signs too of that anxiety, right? When it comes to rising rates on CDS rates, for example. When it comes to Japan specifically, obviously there are tools, and as a former yen rates trader and strategist, you would know better than most people. Do you think there's going to be more tweaks from the Ministry of Finance or from the BOJ that can alleviate that, or are we going to continue to see longer-term yields rising, curve steepening?
Well, the demand structure for the long end of the Japanese government bond curve has changed over time. I mean, these things tend to happen, and I think the Ministry of Finance, which has a slower cadence in how it adjusts its issuance program, will eventually get the message from the investor community that it needs to pare back its issuance. But exactly the time frame for that is unclear. And I think in the meantime, you still have a tremendous amount of supply hitting the long end of the Japanese government bond market, which is presenting value for investors outside of Japan. When I travel to countries like Canada, Europe, even different parts of Asia, including here in Australia, I see investor interest to engage in the long end of the Japanese government bond curve. So I do think that demand is showing up. It's just, can that be supplemented by lesser supply coming from the Ministry of Finance?
Is it also sort of veering away from the U.S. Treasury markets, given the relative attractiveness with these long-term uncertainties?
So I think Shery's question was sort of on whether this is part of the broader doubts over US exceptionalism, right? That investors are looking for alternatives given the concerns over US assets. I mean, I think it's interesting that even the reaction to the US-China talks positivity is skewed towards benefiting the yuan versus the US dollar. Do you think that is a narrative that, can be reversed, or is that a trend that we're going to continue seeing when it comes to US rates, US dollar, broader assets?
So I think ultimately, the biggest driver of where the dollar has been over the past several years have been U.S. rates, and U.S. rates have been stubbornly high in this range, somewhere above 4% on the U.S. 10-year Treasury yield. I do think that over time, as the negative effects of tariffs start coming through more clearly in the data set, you should see long-term Treasury yields gravitate lower. And that will drag the dollar further lower in our forecast. So up until this point, April 2nd was a demarcation date, if you will, for the US dollar. We saw it really diverge from the path of longer-term US interest rates. But we think that differentiation that occurred between April 2nd and today was a natural term premium that shows up in the marketplace. I expect that term premium won't expand any further unless reciprocal tariffs are raised again. But as long as reciprocal tariffs remain where they are today, then I think as U.S. rates do move lower over the next 18 months, you will see a continued depreciation in the U.S. dollar, for sure.
And the tax situation as well, right? Tax policy, the fiscal situation, does that weigh into it?
So the fiscal situation is important, absolutely. But when we look at the scoring of the bill that went through the House of Representatives, it was scored at about a $2.5 trillion increase in the deficit over the next 10 years. But when we integrate the scoring of tariffs, you have almost an equal offset to that increase in the deficit. So if the House bill were to become the law of the land, which is, we're not expecting it to, but if it does become the law of the land and the tariffs remain in place, we could actually see a downside surprise to the deficit trajectory in the United States.
Money markets remain very positive about further Fed support going into the rest of this year. We're also now hearing that potentially Treasury Secretary Bessent could be a replacement for Jay Powell. Give me your thoughts around that in terms of kind of how consistent Chair Powell's leadership has been during what is a pretty nightmarish scenario for all global central bankers, right, trying to navigate a trade war.
I think Jay Powell, as the chair of the Fed, has been tremendously consistent in his pursuit of the two goals that are mandated by Congress for him to pursue. Stable prices and maximum employment. I think that's where he's focusing. I expect that if the data were to come in line with the Morgan Stanley baseline forecast, we have a little bit higher inflation in the third quarter of this year, and then we pass the peak of inflation moving into 2026, and we start to get the more negative effects on the U.S. economy from the tariffs themselves, that Powell will begin to lower interest rates before his term comes to an end as Fed chair in May of 2026. We're expecting him to deliver at least one rate cut by the time he passes the baton to his successor, whoever that may be. In terms of Treasury Secretary Bessent, we're expecting him to, fulfill the mandate that he's been given, especially on how is he going to finance the U.S. deficits that are forthcoming. Even if the deficits aren't as concerning as investors may believe today, he still has to figure out how to finance those deficits. And in that regard, he has a decent amount of flexibility. He can use more treasury bills to finance the deficit. He can increase coupon sizes to a lesser degree than what I think investors are expecting today. He's got flexibility, and I would assume that he uses that flexibility in his pursuit of his mandates.
Matt, I wanted to get a little bit more insight, given your extensive experience working in Japan. When you look at that market, particularly the bond market, but sort of more broadly, given the reforms and progress that Japanese assets have made over the last 5, 10, 20 years, how important do you think Japanese bonds are in a global context now, in terms of, are we seeing more attention being paid by foreign investors, particularly as we've spoken about in an environment where they're looking for global diversification?
Yeah, Japanese government bond yields for the large majority of my career in markets were seen as the anchor point for global duration. So, and for most of that period of time, the anchor for global duration continued to sink and sink and sink. Now Japanese government bond yields are rising. So in that regard, they can no longer be viewed as the anchor for global interest rates. But in the end, what generally drives government bond markets more than any other factor is not supply, it's not economic activity, it's how the central bank is responding to the data that it sees and how it then chooses to pursue its mandate. So for the Fed, it has a dual mandate. I would say if the Fed needs to lower interest rates in order to achieve its dual mandate, that will drag other interest rate markets lower, particularly the US, of course, but we've already seen other central banks outside of the US, the ECB in particular, but I think increasingly the RBA, the Bank of England, we've seen them start this process also of lowering interest rates. And so even though Japanese government bonds may no longer be considered the global anchor for bond markets, other central banks are acting in ways that I think ultimately lead to lower interest rates around the world.
Matt, really great to have you with us today. Matthew Hornbach, who's the Global Head of Macro Strategy at Morgan Stanley. More ahead here on the Asia Trade. This is Bloomberg.
Take a look at how Japanese assets are trading at the moment. The Japanese yen holding steady at that 144.78 level. We saw significant weakness against the U.S. dollar in the overnight session. We had heard from Bank of Japan Governor Ueda saying that there's limited room for policymakers to stimulate the economy. That sent the yen under a little bit of pressure. We have seen the Nikkei, though, gaining ground now for fourth consecutive session. When it comes to the topics, we're talking about tech, healthcare, materials leading those gains. But of course, overall, we're seeing a little bit more positivity when it comes to the Asian markets on that U.S.-China trade negotiations wrapping up in London after 2 days of talks. Continue to watch the JGB's market. We have seen the recent sell-off. The finance minister, Katsunobu Kato, saying that the government will work to diversify JGB holders. But there's been a lot of movement in the financial markets here in Japan. So it's not surprising that Japan's financial firms are pulling out all the stops to attract and retain talent in a highly competitive job market. Young recruits are fielding multiple job offers, being courted with dinners, other financial perks, and some banks are just refusing to let staffers resign and even throwing parties to lure former staff back. Let's bring in Bloomberg's finance and investing reporter Lisa Du to discuss today's big take. I mean, we have seen this optimism about the change in corporate governance here in Japan. And of course, the labor market being what it is here, it must be tough for these financial firms to attract these people. This is pretty extreme.
Yes, like you said, the Japan markets really had a comeback boom in recent years. There's the return of persistent inflation. Even though the Bank of Japan has raised rates, its borrowing costs are still very low. That coupled with that corporate governance reform, companies here being more dynamic about M&A, about business expansion. So that's kind of led to this overall surge in trading of Japanese stocks, of bonds, and also way more deal-making and investment here. And so if you are an investment bank, you're a brokerage, you're a private equity firm, what do you need to take advantage of that moment? It's really, you need talent, you need headcount, and especially kind of younger people is what we have heard, from our talking to many financial executives, recruiters, and employees.
When I was speaking to the CEO of Bank of America last time, he wanted to expand here in Japan as well. But I asked him, what's happening with hiring? Because that's always an issue, right? And he was like, well, we'll bring people from abroad. I mean, the labor market in Japan, the demographics itself really don't help.
No, like you said, Japan really has one of the world's tightest labor markets among G7 countries. It has the lowest unemployment rate, about 2.5, and that coupled with kind of this aging demographic, there's less and less young people entering the workforce every year. And what's more, these people entering the workforce have way more options and they have different ideas about what they want in kind of an ambitious career that may lay outside of finance. So it's kind of this kind of adds another unique kind of difficulty element for these financial firms that are trying to hire, take advantage of this moment, but running up against kind of a chronic labor issue that's become way more acute.
I mentioned dinners and things that people can do to attract this young talent. I mean, we're financial markets adjacent. Could we get some of those perks? I mean, what are they doing right now?
Yeah, it really makes you want to maybe consider a career in finance now. But we heard good and bad things from our reporting. Obviously it's Wall Street, so the salaries are indeed increasing. I think some traders were getting 15% bumps year on year. Some investment bankers we spoke to said they were raising their offers about 10% every year for the last 3 years. So that's certainly a good perk for these guys. We also heard about some extreme cases where, kind of young recruits who are maybe trying to turn down job offers, where, getting pulled into meetings where they didn't feel like they could leave, or into these really fancy private dinners, being pressured to take the job offer. And so it's kind of, I guess, depending on what kind of courtship you like it, but definitely paints a very interesting picture of what's happening here in Tokyo.
Yeah, I mean, the enthusiasm over this market, incredible. Lisa Du, great to have you with us. Of course, we have the big take today. Do check it out. Bloomberg's finance and investing reporter here with me. As we're also getting breaking news out of Los Angeles, there's a curfew now. Mayor Karen Bass now saying that the curfew in LA will start at 8 p.m. tonight. It will run until 6 a.m. local time. This, of course, as we continue to see the anti-deportation tensions in California. Marines have been deployed. You can hear right there the ongoing press conference. But at this point, Mayor Bass saying that the curfew area will be about 1 square mile in downtown and will run from 8 p.m. to 6 a.m. local time. Take a look at some of the stocks that we'll be watching when markets open in Hong Kong, Taiwan, and mainland China as well. Watch rare earths companies in China after U.S. Commerce Secretary Lutnick said that he expects trade barriers on critical minerals to be resolved. Also keep an eye on Taiwan's biggest insurance companies after losses doubled in May from a month earlier due to historic gains in the local currency denting the value of their foreign investments. And this is a picture in the future space. We are seeing some broad positive sentiment across markets. The MSCI Asia Pacific already at the highest level since 2021, although a little bit of downside in U.S. futures as the day progresses across Asia. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. This is Bloomberg.